Hello and welcome to my YouTube channel. Before watching the video, don't forget to subscribe. Welcome to our video on ROCE, or Return on Capital Employed in the Stock Market. ROCE is a key financial metric that measures a company's ability to generate profits from its capital investments. It is a crucial tool for investors to evaluate a company's performance and efficiency. To calculate ROCE, you need to divide the company's earnings before interest and taxes by its capital employed, which includes both equity and debt. ROCE is a powerful indicator because it takes into account both debt and equity, giving a more accurate picture of a company's profitability. A high ROCE indicates that a company is using its capital effectively to generate returns, while a low ROCE may signal inefficiency or poor financial health. Investors can use ROCE to compare companies within the same industry or track a company's performance over time. The benefits of using ROCE include helping investors make informed decisions, identifying strong and weak performers, and assessing a company's ability to sustain its profitability. By understanding ROCE and how to calculate it, investors can make more informed decisions when buying or selling stocks. I hope you understand the concept of ROCE in stock market. Comment your opinion, like if you enjoyed the video, and subscribe to the Tectonic Motivator channel for more interesting updates.